Good afternoon, everybody, and welcome to today's edition of HFM's Friday webinar. My name is Emmanuel Akinola, Market Analyst at HFM Nigeria. Thank you for joining us in the session today. I hope you can hear me and you can see my screen. It's a very interesting topic today that we're going to be discussing the importance of inflation in trading the Forex market, right? Why is inflation important in Forex? Why is inflation something that we tend to accord so much importance when it comes to trading the Forex market? What are the things we need to know about trading inflation? How do we interpret, data when we get reports for inflation? How do we take that to the chart? How do we make that into, trading opportunities? This is something that we're going to be looking at for, in this particular webinar today. One way or the other, you cannot avoid, discussions relating to inflation, and then you'd want to wonder, why is inflation so important? Why is it that days when we have the US CPI or we have CPI from even from some other nations, that we care about in the Forex market, why is it that some of those days the market tends to get quiet before the event, more or less like the calm before the storm, right? The market seems to pull itself into a shed before that particular event, and it makes you feel like, is this inflation bigger than what we know it to be? Why is the market getting calm, or why is the market getting a little bit pressured, before the report, and then suddenly after the report is released, we see some really interesting volatile movement across the market. So what exactly is causing this? How come inflation is accorded this much importance, in trading? One way or the other, apart from the NFP, which is more or less like a scheduled event, and everybody knows it to be the first Friday of every month, I could also tell you that ordinarily, in terms of economic data, the US CPI follows in terms of the most important economic data releases that the market tends to pay attention to. So why? Why is inflation so important? I will need to give you a backdrop. I will need you to, really stay with me. I will need you to keep your focus on this particular session today. It would be really, really important for us to do this. But let us start from, a place of understanding, where we are right now. This is a little bit of fundamentals. Let me just give you like a tree, right? Like a tree. You see, you're trading United States dollars, right? But you need to also note that the name of the currency itself is dollar, right? But also at the same time, the name of the country to which the currency is coming from is attached to the name of the currency, which is why you have Canadian dollar, that is dollar coming from Canada. It is also the reason why you have Australian dollar, that is the dollar that comes from Australia. It is also the reason why you have the New Zealand dollar, right? Dollar coming directly from New Zealand, right? So naturally, we tend to have the name of the countries attached to the name of the currency, why? So that it is known and it is not particularly seen as something different when we begin to study what is going on in the United States as a country, in order for us to understand what is going on with the currency. So the United States is, a major stakeholder in the performance of its currency, which means the performance of the US dollar or the dollar in general, as we know it, cannot be, mutually exclusive or mutually excluded from the United States as an economy or as a country. Why? Because the currency is expected to be a reflection of the purchasing power of those living within that particular country. So it's not possible for us to discuss the potential strength or the potential weakness or even the potential value of the US dollar without talking about, an appraisal of the United States economy as a whole. Now, if we're going to appraise United States economy, or we're going to appraise any economy at that, or any country's currency that we're looking to trade, right? We cannot appraise these countries' currencies or their economy without their central bank point of view. Now, it means I need to get some reports from the central bank, right? Because the central bank necessarily has more information that Google can even provide to you when it comes to the value of an economy or what is currently going on in an economy, right? Google might lag in the sense where maybe the data it has last is maybe 2024, it has not updated 2025 data and some of those things, but the central bank is expected to have much more recent, correct information about that particular business, right? So if anything, one major thing that we want to ensure that we do is keep in touch, right? So now for the US, the central bank of the US is known as the Federal Reserve. Federal Reserve. Federal Reserve. Otherwise known as the Fed. I don't think I have space, but it just means Federal Reserve. Now, the Federal Reserve has been empowered to make policies to ensure that the value of the country's currency is not just porous, to ensure stability of the value of the currency. So the central bank's major function is stability, ensuring stability of an economy, and ensuring that the value of the currency is not just random or useless, ensuring that from time to time, they create policies that is needed to, combat certain things that an economy may potentially be going through. An economy that needs growth can be fixed with policy. An economy that needs to shrink its growth can also be fixed with policy. Now, which means the major function of the central bank is create policies, use policies to adjust the economy just for the sole purpose of achieving price stability. Now, but you see, the central banks is being, touted to create policies implement appropriate policies. And some of these policies are aimed directly at either improving the value of the currency sometimes or even actively, devaluing the value of the currency. Yes, sometimes the central bank can actually devalue the value of the currencies. Well, eventually, you can see that everything is still going back to the currency. So when central banks or the Federal Reserve implement policies, one way or the other, the effect is expected to be seen on the currency. Now, the policies of the central bank is where we're going to. You see, majorly, the central bank works with two major policies, interest rate and money supply. Naturally, there are also other ones, but majorly interest rate and money supply. But for us, interest rate is the most important one right now. So you see, in the case of interest rate, as a policy that the central bank can potentially look forward to do or to implement in a nation, it is either the central bank hikes interest rate or they look to cut interest rate, which means it is either the central bank looks to increase their interest rate or the central bank looks to cut their interest rate. So the central bank can either decide to hike interest rate or the central bank can decide to cut interest rate. But what do you think determines the central bank's decision to either go in the pathway of hiking interest rate or go in the pathway of cutting interest rate? Hiking interest rate means to adjust interest rate higher, that is to increase interest rate. Cutting interest rate means to drop interest rate by decreasing it, right? So what do you think decides the central bank's decision to either go the pathway of hiking interest rate or the pathway of cutting interest rate? You see, one of the major decider of the pathway the central bank is going to take to either hike or cut interest rates is that inflation. So the question, why is inflation important in Forex? Inflation is so important in Forex because central banks pay attention to inflation to decide how they are going to adjust their interest rate. I'll repeat that. Inflation is so important in Forex because inflation is a metric or an economic indicator or data that central banks pay attention to decide how they are going to adjust their interest rate. And if you're wondering why the adjustment of the interest rate is so important to us in the market when it comes to currency valuation, the thing is this. When the central bank decides to hike interest rates, this is seen as being aggressive. Why? Because, increasing interest rates means increasing the cost of borrowing, which means firms, corporations who might need to, get money from the banks to expand their business might not be able to do that. Even individuals might not be able to, get access to credit facilities easily because of, increase in interest rates. So it's assumed aggressive. And for that reason, we understand that this mops up excess money in circulation, which means the demand for money is naturally going to be higher than the supply of money. And this means that when a central bank decides to go the pathway of hiking interest rates, it strengthens the currency. The currency becomes strong. So hike naturally will strengthen the currency. But on the other hand, when they decide to cut interest rates, therefore reducing the cost of borrowing money, a lot of corporations, firms, industries will look to get money from the bank to expand their businesses. By so doing, they are increasing the flow and the supply of money in circulation, which is definitely going to make supply higher than demand. That's seen to be less aggressive. And this weakens the currency. So once again, why is inflation important in trading? Inflation is so important in the Forex market because inflation is a key data that the central bank will look to decide if they are going to cut or hike interest rate. And this gives us a trading opportunity because if they decide to hike interest rate, we understand that that simple action is going to strengthen the currency. And we also understand that when they decide to cut the interest rate, that single action is going to weaken the currency. So the importance of inflation is such that we can see and we can understand what the central bank is potentially going to do with their interest rate. The most important thing for us to note is The only thing that most likely leads the central bank to hike interest rates naturally, it is a defense system to higher inflation. When inflation goes up, the central bank defense system to higher inflation is to naturally increase interest rate. In Nigeria, we understand that the inflation rate, according to public figures, is not less than 34%. It is also the same reason why the interest rate in Nigeria is also not less than 27% right now. Why? Because the Nigerian Central Bank, the Central Bank of Nigeria, continues to increase interest rate or hike interest rate in order to control the persistent rise in the prices of goods and services. And under normal circumstances, under normal environment, that is expected to strengthen the currency. The central bank cuts interest rates only when inflation drops lower. So lower inflation warrants the central bank to cut interest rates. So when inflation goes up, we understand that the central bank's natural defense system is to look for how to hike their interest rate. But when we see persistent fall in inflation, almost leading to deflation, naturally the defense system by the central bank to still ensure price stability is to cut interest rate. I think Forex Factory put it in a very interesting way right here. We had CPI for the US dollar on Wednesday. Or was it? Yes, on Wednesday, right? If you look at why the justification as to why the market care about inflation data. CPI, which is Consumer Price Index, is inflation. PPI is also inflation. But if you read this, you get everything I have explained already. It says consumer prices account for a majority of overall inflation. We're talking about inflation, right? It says inflation is important to currency valuation because rising prices, that is when inflation is going up, right? It says because rising prices, when inflation is going up, would lead the central bank to raise interest rates. Because rising prices would lead the central bank to raise interest rates, which means inflation in of itself is not like the biggest data that we look forward to trading, or is not the one that is actually causing the very big reaction in the market. What is causing the very big reaction in the market is traders pricing in the activity of the central bank. That is, when we see higher inflation, we want to price in an aggressive response of the central bank to look to hike interest rates, which strengthens the currency. But when we see inflation go lower, then we also understand that the central bank must also look to cut interest rates out of respect for their what? Inflation containment mandate. You can see, like I mentioned, it's something they must do. It's a defense mechanism. When inflation goes up, central bank already have their own defense mechanism. When inflation also goes down, they also have their own defense mechanism. And naturally, higher inflation strengthens the currency, lower inflation weakens the currency. We saw this happen with the US dollar yesterday. You know, inflation in the US yesterday, sorry, on Wednesday was way below expectation, right? We're expecting 0.3% for both core inflation and the headline inflation. But what we had was 0.2%. If you compare what we had as against what it was previously, it's a reduction. The core CPI last time was 0.4%. Now it is 0.2%. That's a drop in inflation. The headline CPI, month over month, was 0.5% before, now it is 0.2. Even the headline CPI over Y, which is year over year, you would also notice that the previous figure was 3.0 before. We're expecting 2.9%, we got 2.8%, which means naturally every single measure of inflation came in lower than expected. It means the market at no point in time would not be expecting that the Federal Reserve in the US is going to look to hike interest rates. If the central bank isn't going to hike interest rate, which means maybe the likelihood is to either leave it where it is, hold interest rate, or potentially look for an avenue to cut interest rate. By no means, you should expect that this is going to weaken the dollar by every normal metric. By every normal metric. This is expected to weaken the dollar. By normal metric, this is expected to weaken the dollar. Now, if you also look at the next day, we're going to go to the chart a little bit, but if you also look at the next day, we also had, producer price index right here, right? Which is also another form of inflation. But look at why traders care about it. It says it's a leading indicator of consumer inflation. When producers charge more for goods and services, the higher costs are usually passed on to the consumers. Which means under normal circumstances, if producer price index is going up, it is expected that naturally, because producers will not bear the risk of higher cost of production. You must already know that. If there's going to be an increase in the cost of production, producers will not bear it. They will pass it on to final consumers as higher prices, which means if producer price index is pushing higher, it is natural for us to also expect that general inflation is also going to push higher. But if producer inflation is going down, it also means that the general inflation also is not expected to pick up, which means if producer inflation also is moving lower, naturally, we don't expect that the central bank will be looking to increase interest rate. Rather, a fall in interest rate might be the most likely outcome. If you look at what happened with this particular data as well, we had producers price index go from 0.5% previously to minus 0.1%, also 0.6% previously to going to 0.0%, which means clearly consumer prices are lower in the US. Also, at the same time, producer prices index are also lower in the US, which means naturally inflation is down right now in the US, which means at no point in time are we currently expecting that the Federal Reserve is going to be looking to hike interest rates. If anything, the most likely outcome in question will be for them to cut the interest rate, and that should weaken the dollar. We can go to the charts and see what happened with the USD index during those environments. Now, this is baseline explanation of how inflation could potentially affect, the movement of prices in the market, but also at the same time, high risk events, high impact events might not be straight line, where you expect that when inflation comes out below expectation, you're just meant to be selling. There are situations where in the market might not immediately sell. But I want to show you the USD index on Wednesday and on today, and on Thursday to see how the inflation report affected the performance of the dollar, if it did at all, right? Now, this is Wednesday right here. Now, on the news, right? On the news, when inflation was released in the US, initially, the US dollar dropped lower, but immediately gapped back up, which means instead of the dollar to immediately weaken on the report of a bad, CPI print, we saw a knee-jerk reaction. Price went up, but eventually, price still returned lower, responding to the fact that that particular inflation data was bad. We saw the same thing yesterday when PPI was also released. You can see the same thing. Price also clapped higher a little bit, but also responded to the fact that that particular data was actually bad. It's normal when inflation is falling, the currency is expected to lose value. If inflation is rising, it is expected that the currency gains value because of what we think the central bank is going to do. Their response in terms of policies is what weakens or strengthens the currency when inflation is either going up or going down. And that's one thing you need to note. Now, away from, straight line reaction, this is what should be, this is how it should be. Inflation going up is good for a currency. Why? Because it is expected that the central bank would hike interest rates out of their inflation containment mandate. When inflation is going down, naturally, it is bad for a currency. We expect that the central bank will look to cut interest rates, which should weaken the currency. But how the market responds to it at that particular time might still be subjected to price action, might still be subjected to some natural, market responses up until the market eventually settle the dust. One thing I need you to understand is high risk events are high risk events in the market. Okay, high risk events are high risk events in the market, which means the way we approach them is to actually just, wait until the market does whatever volatility it wants to do within that particular environment, okay? There's always that, because the reason why it is called an high risk event is because of the volatility that we get within the environment where the news is actually released, right? That first 30 minutes when the news is released is something that might not guarantee the market eventually moving in the direction to which you've interpreted the particular data. Oh, yes, inflation was bad. Why wasn't it going down? Eventually, it went down. But that 30 minutes within the time that the particular data was released, we saw this kind of volatility in the market. So one thing I need you to note is the market is not random, all right? If a data is bad, that data is bad, irrespective of what is currently going on the chart, especially within the movement of that volatility, the first 30 minutes. That period, the market might move opposite of what the logical reason of that particular data could be. But you just make sure you hold on to what is logical. Hold on to what is logical and wait until the dust settles and follow the logical direction. Which means this data is bad. I should be selling this currency. It's fine. Allow the market do the volatility, leave the market volatile period. When the dust settles, join the market in trading the logical direction. Lower inflation remains bad. Whatever reaction the market has within the first 30 minutes can be subjected to increased volatility, a lot of traders running out, running in, a lot of closed positions, a lot of open positions at the time. That back and forth movement causes increased volatility that might make it look like, why is the market reacting opposite of what you've seen on the data? Oftentimes, do not do yourself a favor, let that particular volatile period pass. When the market settles, follow the logical direction. Follow the logical direction. So the idea of why is inflation so important to trading? There's only one single answer to it. It is because no matter how you think about it, currencies that you are trading are linked back to their countries, and the value of those countries' currencies are very, 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 very linked to the status of the economy. In fact, once again, it's a one-to-one relationship. The currency is the picture of whatever is going on in an economy. Sorry to say, it's the reason why the Naira dollar is currently about 1570 or thereabout. It's a true reflection of what the Nigerian economy is right now. So the same way, the US dollar is expected to be painting a picture of what the US economy is right now. If you look at what is currently going on the USD index, this is the performance of the dollar since ending of February or thereabout. We've seen crazy downside, in the performance of the dollar. And you can also see that in what people think about the US stock market. The US stock market also since 28th of February alone, it's been down also from 28th of February. It's a true reflection of what people actually think about the US economy right now. If people have good faith in the US economy right now, the stock market in the US shouldn't be falling this much. It is also because investors, people are also concerned about the outlook of the US economy right now. In fact, the odds of a US recession is starting to rise. Why? This entire tariff thing, countries back and forth and whatnot, is playing a major role in how investors is viewing the US economy. And you can clearly see that reality on the performance of the dollar. So if we can say that there is a direct one-to-one relationship between the value of an economy or what investors think about the economy, then the currency must reflect a true picture of what is going on in that economy. And if I'm going to appraise an economy, I need to do it from the central bank point of view. And the central bank is also telling me that before I adjust my policy in any direction, there are some things that I tend to look forward to before making that decision. For the Federal Reserve, two of the most important economic data for the Federal Reserve or for the Federal Reserve to decide what they want to do with their interest rate is to look at inflation and to also look at the labor market, which is also explaining why NFP is so important, right? Because price stability, inflation, full employment, labor market, two important metrics that the Federal Reserve would always pay attention to before deciding what way and what direction they need to adjust their interest rate. The adjustment of the interest rate is what matters to us as traders. And we understand that it is either they're hiking or they're cutting, but that is only done based on what picture inflation is putting to the central bank. If inflation is rising, the central bank must hike interest rate in respect of their inflation containment mandate. When inflation is falling, they must also look towards cutting interest rate. But for you as a trader, one thing you must understand is that logically, when inflation goes up, it is naturally expected to play out as strength to a currency. Why? Because the market prices in the activities of the central bank to hike interest rate. But when inflation goes down, you should also understand that it weakens the currency. Why? Because traders will tend to price in the activity of the central bank by cutting interest rate. Mine is inflation data is high risk event. So at the time where it is released into the market might not be the best time for you to start saying, ah, but it came out bad. Why is it this direction? Naturally, high risk events, increased volatility, a lot can happen within the first 30 minutes of that data. You allow the market settle, let the volatility die down, analyze your data, see that everything is in order, and follow the logical direction when the dust settles. When the dust settles, you just have to follow the logical direction. What is the logical direction for the dollar in the face of lower inflation, consumer prices, lower PPI, producer prices? It is weakness. So no matter what I see or whatever is going on the dollar right now, it might not deter me too much from what I think is the logical conclusion, which is to be buying Euro USD. We mentioned this today on our trading floor, looking for upside because the dollar's weakness is not going to change. Euro USD, AUD USD. Why? Because we understand that volatility exists in the market, but we must not throw logic away from the window. You must still stay with the most logical direction. You must still stay with the most logical direction. So, ladies and gentlemen, it doesn't even have to do with dollar alone. All central banks, their inflation data gives us a picture of what the central bank might potentially be looking forward to, and we're pricing that activity. We don't need to wait for the central bank to cut interest rate the next minute before we trade the direction. No, no. We're pricing the activities ahead of time. Pricing the activity ahead of time. Do you have any question that you want us to attend to, especially in regards to how inflation affects the valuation of a currency? Please put it in the Q&A. I'm going to read them out and I'm going to answer them. Please put any question you have about inflation and how it affects the value of a currency on the Q&A. We're going to answer them in the session today. All right, I believe it was quite straightforward. It was quite an informative and educative, one about the influence of inflation on the currency market. All right, it is quite important, and I think this is nice. All right. We must also understand that inflation also has ways of affecting some other assets, especially if it is the US CPI, right? I'm not talking naturally about other, currencies in the market, right? But when it comes to the US CPI, it has a way it affects some other assets. For example, the US CPI is also going to affect the stock market. Naturally, higher inflation isn't good for stocks, especially if you're trading equities, naturally, because if the central bank is going to have to increase interest rates, right? Higher inflation, which means hiking interest rate comes into play. If this happens, companies will feel the heat. Why? Because companies don't rely on money that they own alone, they borrow money. So the fact that there's going to be an increase in interest rate means stocks also will feel the heat. Stocks, equities, drops on higher inflation they fall on higher inflation, but stocks will tend to rise on lower inflation. You'll be wondering why US 500 and US 30, NASDAQ, Dow Jones didn't rise so much despite low inflation figures, in the US recently. Well, it is because even the fact that inflation is going lower does not really change the overall overview of the US economy right now with some of Trump's policies, with the tariff issues and all of that. And that really explains some of the things that we're seeing. So naturally, stocks as well, equities are expected to rise on the fact that the central bank could potentially, cut interest rates, right? So equities also have like major reactions when it comes to um, inflation and how it affects other markets. For example, also higher inflation naturally, because of the response of the stock market, might also give birth to higher yields. And higher yields naturally means that we might see weak JPY. But in the case where we see lower inflation, all right, which leads to lower yields in the market, right? We do expect that the JPY is expected to enjoy a little bit of strength based on this particular, you know, reason as well. The relationship between inflation and gold used to be strong before, but maybe right now, because the markets or the drivers for gold right now are not entirely straightforward. But naturally, higher inflation strengthening the dollar would temporarily weaken the gold at that particular point in time. But eventually, because higher inflation causes the central bank to eventually hike interest rate, we will naturally see a capital flight from equities into safe assets, which means in the long run, there will still be some upsides for gold. But maybe at the moment of the release, we might see a potential drop in gold prices just because dollar will be very strong at the time because of the inverse relationship. But I'm not even going to put that on the screen because that's not strong anymore. All right, we understand that dollar can be rising now, gold is also rising, right? Dollar can be falling and gold is going to where it's going to. So we're not going to put that as one very strong metric in terms of how inflation could potentially affect some other markets like equities market. Importantly, equities market responds also to inflation. The energies market also responds to inflation as well. The US or UK oil also respond to inflation, especially the US inflation. Maybe not as strict as the currency market would respond, but at least we still see some form of response even across the energies market. So I think, yes, this is also important for us to know. How long should you wait from data before placing it? At least you see the first volatile 30 minutes, because most times NFP is always like maybe 130, CPI is at 130. The first that 30 minutes after, from 130 to 2 or from 230 to 3, is not the time for you to even think about, trying to trigger a position. You must let all of those environment calm down. You must let the dust settle. There's no straight answer, but at least that first 30 minutes is maybe a no-go area because of the increased volatility that we have in the market. Is unemployment rate also part of inflation data? No. Unemployment rate is part of labor statistics. That is a measurement for the labor market, right? That's a measurement for the labor market. Yields also play a major role in currency valuation, all right? It is important, right? You see, because bonds are safe assets, right? And if so much money goes into if yields rise, it supports the currency, especially for the US. Higher yields is good for the dollar, and that naturally will weaken stocks, and that naturally will also weaken the JPY. But lower yields is bad for the dollar, and that would naturally help stock prices to rise and also strengthen the JPY. Okay. So I think this just helps us with really understanding the place of information and the play of inflation when it comes to currency valuation in the market, right? So thank you guys for coming for this live session once again. Thank you for coming. If you have any questions, you can still send it in. All right, this will be answered. All right, thank you guys for joining us today. Thank you for coming to this beautiful session. Once again, my name is Emmanuel Akela, market analyst at HFM Nigeria.